Hello and a warm welcome to Talking Stocks. I'm Gugulethu, Cele, and as always, I'm joined by both Sean Ashton and Peter Armitage, both from Anchor Capital. Now, today we talk about a cement maker which is well known in the South African sphere and is starting to gain some traction on the rest of the continent. We talk PPC, which is listed on the Johannesburg Stock Exchange. Sean, let's start off with your view on PPC overall. I think many of us just think of that elephant that tries to conquer the rest of the concrete jungle, literally, in South Africa.
I think this is a business that's come through some enormous challenges, and there are some signs of life now, but there's still a number of risks. And I think the principal point to make is that it's a business with high market shares in South Africa, but they're not the most efficient operator, and you've got a very slow growth environment in the South African context, and you've got new supply coming in. You've got Sepaki, you've got others totaling quite a number of millions worth of tons of production. And I think that's removed an element of pricing power for PPC. So their volumes have slowed significantly, their prices have slowed, and you've got a business in South Africa that's stagnating and declining. But at the same time, they've got cash flows, which they're investing into Africa. And those projects, if they deliver on them properly, come with quite high returns. So there could be some decent value there.
Let's not forget that they did try to acquire Afrimat not too long ago, and that deal fell apart. AfriSam, excuse me. The potential that could have had, though, Peter, from your side?
I think it would have been a disaster. This business has been mismanaged from a balance sheet point of view. I think if you look back 5 years ago, they were paying out a huge amount of their earnings as a dividend, then embarked on huge capital projects and took on debt. And you'll end up now with a balance sheet, together with the plans that they have, which has got an enormous amount of debt, 7 billion rand of debt. To put it in context, their market capitalization is around 12 billion. And they've got projects which will take that debt up to 12 billion. So and they're still paying out dividends, which mystifies me. And I think to me, PPC, besides the operations, is part of the shareholder community misdirecting a management as to what to do with their balance sheet. There were huge demands on dividends, and this thing was valued on a dividend yield. They paid out all the cash, and now there's a possibility they actually have to go and raise cash. This share price was 35 Rand plus. If you look back a year,
5 years even, yeah.
Well, even a year ago and 5 years ago. So it's gone flat and then plummeted. And the worst possible scenario for a business is having to raise capital at the bottom. Not suggesting they have to do that, but the balance sheet is now got far more debt or risk than I would be comfortable with.
Would raising capital be easier, though, given the valuations, Sean? It does seem slightly cheaper than its global peers.
Well, that becomes problematic. I think that's exactly the point that Peter's making. If you have a low P multiple on your shares, raising equity capital is suboptimal because it then becomes very costly.
It's expensive because you have to issue a lot more shares.
The lower your share price is, the more shares you've got to issue to raise a given amount of capital. So that becomes quite dilutionary at an extreme.
The message we're sending is not they're about to have a capital raise. They're certainly hoping that won't be the case, and that's not our base case.
Yeah.
We're just saying that, if you take the business where it was to today, I think if you told people where it would be today 5 years ago, they wouldn't have believed you. Obviously they were paying out all the dividends in the expectation that profits keep on going up. But business changes. We always say in the analyst world, you write a report. 3 years later, you go back and look at a report and you can be a little embarrassed because how quickly the world changes. It's not predictable.
Let's talk about those changes, because obviously that has influenced the sum of the parts valuation. You mentioned South Africa obviously under pressure, African expansion not really picking up as quickly as they wanted to be. So being hit from both sides, I take it.
Yeah, I think Africa comes with promise because a lot of these operations a lot of the countries they're looking at moving into have per capita consumption levels of cement that are a fraction of South Africa, in many instances a tenth. So there's certainly opportunity there. With that comes risk. But I mean, the way that we've tried to approach it in terms of valuation on PPC is to say South Africa, their margins have come from 40% at an EBITDA level to 26%. It's not obvious that that's going to turn around anytime soon. So that demands a low multiple. You shouldn't be placing a very high multiple on the South African business. Their global peers traded about 10 times EBITDA, just in terms of a valuation parameter. They're sitting at about 8 times. So we've said South Africa should deserve a discount. And that amounts to about 21 rands a share once you've stripped out the debt. There's 7 odd billion rands worth of debt in the business. So if you're looking at this year's profits, 8 times EBITDA is 21 rands a share. You've then got to take a view on Africa, and I think certainly those projects, the metrics look very profitable. With it comes a lot of risk. So we've applied a very similar valuation metric to that, which gets you to another 4 rands a share or so. So potentially, the business could be worth 25 rands per share if they execute properly on some of these projects that they're talking about. But again, what we haven't taken into account in that is this carbon tax, which most likely will come through. And they're talking about 150 million rands profit impact. Well, that's a negative 2 to 3 rand a share on the valuation of PPC. So I think the share price got very low. It's bounced back quite sharply now, and there probably is still some value in it. But I think that it's important to recognize that if things go wrong, there's very little margin of safety in this business. So when you've got a market cap of 12 billion and debt of 7 billion,
heading to 12 billion.
Heading to 12 billion. If South Africa carries on worsening, in other words, we're saying that profits we hope will stabilize in South Africa. If those operations continue to worsen, you've got a very highly leveraged balance sheet, and your valuation is very sensitive to where profits go because you've got this high level of debt. So it looks like there's some value, but the risks are certainly there.
That does make for a scary wake-up call, especially if you look at the local environment where infrastructure spend isn't being boosted from government,
and
slow
new
economic growth. Exactly. Let's touch on those competitors. Even though government has stepped in with the anti-dumping tariffs, will that work to their advantage with the dumping from Pakistan of cement?
Certainly, I think, and what's quite important is that PPC dominates the Western Cape. So cement, a lot of the cost of cement is transport. So it's not that viable to import stuff into Durban and ship it into Gauteng. It adds quite a lot. The transport cost adds a big percentage to the cost. So the coastal operations, and particularly the Western Cape, if you're operating on the coast, you're much more sensitive to imports. And that's certainly the case with PPC, and they saw a big margin erosion and price impact in the Western Cape. So it provides them with some headwind. But ultimately, again, it's one of those macro factors. If you've got people around the world, it's the same with the chicken guys. From year to year, the protection disappears and it comes back in, or they do it illegally. You've constantly got some biting away at your pricing power because there's global players who can export it and land it in South Africa significantly below the price that PPC's selling it at.
Let's go back to some of the projects that they have on the rest of the continent: Zimbabwe, Rwanda, DRC, and also it does seem as though Ethiopia is looking as though it's one of those projects that could brighten up quite significantly. From your view, Sean?
Sure. So I think these projects collectively, and I'm going to leave out Ethiopia for the time being because they're talking about a potential revision to the capital costs on that project, which may result in an impairment. So we haven't gone and said let's add a certain amount of value for Ethiopia because that they may have to actually impair some of the costs that they've already capitalized. But if you look at Zim, Rwanda, and the DRC, you're talking about potentially another 2.5 million tons worth of production that's going to come in. Bearing in mind, so just to contextualize it, PPC has current effective capacity of about 6.5 or 6.8 million tons in South Africa. So it's adding another third to what PPC is today. They won't own 100% of all of these projects. It's between 50 and 70% in most cases. But I think the attraction of it is that the pricing of cement in a lot of these markets is quite high. You're talking about retail pricing of, in some instances, $270 a ton, which is pretty high. So the returns on these projects will be high. The return on capital is high. And importantly, they can use a lot of debt in the capital structure. We think they'll gear them to the extent of 70% in many instances. So on the equity that they're committing to these projects, there's every possibility that they could get a 30% return on equity once the projects have reached maturity. So they look on paper like very good projects, but again, you're dealing in jurisdictions that are not necessarily that close to home, so there's risk.
I want us to talk about how they can mitigate that risk there, Peter. As both of you have mentioned, a lot of debt. They might need to raise capital here, and the heavy investment that they're doing in these outside projects. What do they need to do to make sure that they do it right?
So I think just project execution excellence, having the right people. But ultimately, if you put a cement plant down, you can't pack it up, put it in a suitcase and take it home. Having said that, I'm fundamentally positive on what they're doing in Africa. There's the old concept of what they call BBC. If you invest in developing markets, it's beer, banks and cement. Because those are the things that tend to always benefit as people get richer and countries get richer. So I quite like the African thing. So you've got in PPC, it's one of those shares I can sit and construct and convince you to buy the share or convince you that the risk is so high it's not worth the risk. And in fact, I was at an investment presentation yesterday with a well-respected asset manager, and PPC is their top share. So you can construct that argument. But I think the we don't like to lose people's money. I think that, this is one where you've probably got a 70% chance, with a lot of factors out of their control, of it coming through the debt and coming through. The thing that actually worries me the most is probably South Africa, remaining subdued and going down further, because they need that as the cash cow. But you've got a 30% chance, and it might be nothing to do with anything that they do. That the number of cumulative risks they're taking, one of them really weighs down on them. So we take a measured view of it.
And I think the other important point to make is that when you talk about risks relating to South Africa, which is, as we know, the bedrock of what this group still is, yes, we've got import tariffs on imported cement now, which will protect them to an extent, but the new competitors that have come in on the inland regions, which is where they would be less affected by imports anyway, are producing cement at a significantly more efficient cost base and rate than what PPC can do. So they can still undercut PPC on pricing. Sepaku is the obvious example. They can undercut by a few percentage points and have comparable quality on their cement. So I think it's hard to construct a case that PPC will not necessarily continue to do share in South Africa in the inland region relative to new competitors.
So Sepaku, for example, is getting up to above 20% market share in a place like Cashbuild.
Sure.
So making a big impact.
Time now to get that all-important question answered by our experts: buy, hold, or sell. Peter?
So I take a small bet with my own money. I like it. It's very highly geared. There's a lot of risk in it. And this share from 20 Rand could be 35 Rand in a few years' time. But in a portfolio, it's quite risky. If you're risk averse, we wouldn't hold it. So I guess we'd place a small bet on it. It would be my conclusion.
If you're quite adventurous, then quite clearly you like this one. Sean?
I think in a market that looks relatively fully priced from a valuation point of view, here's one share which we can construct an argument that trades slightly below our fair value. The risks are high. But I think the recent news flow has, if anything, turned positive. You've got import tariffs now, which protects them on the coastal region, and I think the share price can move higher. But I think I'm more or less on Peter's page, where this would not be a 5%, a 5% or a 7% in a portfolio. You've got to take a very measured bet here, because there are risks, and if things go wrong, it can go very badly wrong for them, principally because of the structure of their balance sheet.
Mm-hmm. So understanding the risks and being very cautious with your positioning quite clearly on PPC. Well, that's where we leave it for Talking Stocks today. A big thank you to both our guests, Peter Armitage and Sean Ashton, both from Anchor Capital. Join us again next time where we talk more stocks.